There are a couple of potential questions as far as variable annuities and taxes. So I want to talk about some tax situations here. So we put in the $200,000 at age 30. And let's say that we annuitize at age 60. Well, we annuitize at age 60. We'll do that story first. So $400,000 is the value in our account. Our cost basis is what we've paid in. They look us up on the annuity table. They think we're going to live to be 80. So my money is going to come to me by the time I should die. So $400,000. Now this is a little bit simplistic. We're not going to worry about the fact that there's earnings after you annuitize. There is in the real world, and it's a little bit more complicated. But for the test, this is all we need to know. So we have $400,000 paid out over the next 20 years. So we're basically getting $20,000 a year. The question is, how much of this is taxable and how much of it is tax-free? When you annuitize, they take your cost basis, the $200,000, and they spread it out over your life expectancy. And so that we have $200,000 divided by 20 years. So $10,000 a year is tax-free. So my cost basis comes back to me a little bit every year. The earnings, the other $10,000, how is this taxed? Taxable as ordinary income. Taxable as ordinary income. Test question. Let me ask, if you live past age 80, do you still get paid? Of course you do. So past age 80, whose money are you getting? Someone else's, so that after age 80, the money that you're getting is 100% taxable as ordinary income. Because none of it is your money. So if you live past your money, all of what you get after age 80, it's 100% taxable as ordinary income. Let's see, one more thing that they might do here. We paid in our $200,000, age 30. Why do people put money into variable annuities? Because they have tax-deferred earnings during the pay-in, and it's a way to save for retirement. So it is a retirement product. Variable annuities are retirement products. So let's say that here you are at age 50, and you didn't decide to annuitize, although if you do annuitize at any age, there's no penalty. But here we're not going to annuitize. Here we're going to take a partial withdrawal. So when you're age 50, your account balance, let's say, is $325,000, and you decide to take out $50,000. The question is, how's the IRS going to tax this? Well, they got things figured out. They're going to tax this what we call LIFO. So a partial withdrawal is taxed LIFO, last in, first out, which means that this $50,000, how much earnings do we have in the account as a whole? $125,000. So the $50,000 represents earnings. How is it taxed? 100% taxable as ordinary income. Plus, I have a 10% early withdrawal penalty because this is a retirement product and I'm under age 59 and a half. So if you take a partial withdrawal under, or a full withdrawal for that matter, under age 59 and a half, your earnings, not only are they taxable at ordinary income rates, but you also have a 10% early withdrawal penalty because it is a retirement product. Now, if you were taking the money out to pay for college or death or disability, they are going to waive the 10% penalty. The earnings, however, are still going to be taxable at ordinary income rates. So I do expect you will have a question on a partial withdrawal. It is taxed LIFO. And the only time the penalty applies is if your client is under what age? 59 and a half. There is another product that potentially could be on your test called an equity indexed annuity. Equity indexed annuities are not considered to be securities products at all. Because an equity indexed annuity has a minimum guaranteed interest rate, it has been ruled that they do not fall within securities regulations. So you would not have to have a Series 6 or a Series 7 to sell one of these products. Equity indexed annuities. They're fairly popular. So they are not considered to be securities because of that guarantee. Annuities as a whole, whether or not it's a fixed annuity, which is not a securities product either, or it's an equity indexed annuity, or it's a variable annuity, all annuities products have significant surrender charges in the early years of the policy. So none of these are intended to be used as a short-term investment vehicle. Annuities are always expected, they're best utilized as a long-term investment tool. An equity indexed annuity is regulated by state law, as would a fixed annuity. They are insurance products. I already told you how important it is to make sure that your client's life insurance needs are met. There's different kinds of life insurance. There's cash value life insurance, whole life, which provides you with permanent protection until age 100. There is term insurance, which has no cash value, is much less expensive in the short run. The premium is much less expensive for term insurance than a cash value whole life policy would be. But if you pay in for 30 years into, let's say, a 30-year level term policy and you don't die, well, you don't have anything to show for it. So term is less expensive in the short run, but if you don't die, you don't have any cash value. There's universal life insurance products that has a term insurance component and an interest-bearing savings account component. Universal life tied to interest rates. So universal life is popular in times of higher interest rates. And then there's variable whole life. So a variable whole life policy would combine the permanent protection of a whole life policy, so protection until you are age 100, along with the premiums going into what's called the insurance company's separate account, just like the variable annuity. And the rate of return in the separate account is the rate of return in the stock market. So variable whole life, you have a minimum face amount. Depending upon the performance of the separate account, it is possible that more than the face amount is paid when your client dies. Variable whole life, it's a fairly popular type of life insurance policy. So life insurance needs must be met, definitely within your realm of responsibility. For a client to buy life insurance, they must go through a physical exam. They must pass a physical because it is protection. The insurance company is betting that they're not going to die. Of course, the person buying life insurance is betting that they might die tomorrow. Otherwise, why would they buy life insurance? So within your realm of responsibility to make sure that your client's life insurance needs are met. You'd have to have an insurance license, of course, and if you're selling variable product, you'd also have to have a Series 6 or a Series 7 license as well. That concludes our discussion for investment vehicle characteristics. Make sure that you're doing well on the section exam. Don't forget, you can always email me if you have any questions. You can reach me through the email system online. Good luck.